All right, everybody, welcome. Hey, we're live. I'm David Pipe. I'm here with Rob Kent, and we love to do these once a week. Jump on at lunch and talk through a real estate topic. So today we're talking about is buying a house really a good investment? And before we get into it, a couple of things. First of all, this is like a high level overview. So we're not going to do a deep dive in the next 10 or 15 minutes into the numbers. Second thing, this is about your primary residence. So we're not referring to a secondary or cottage property or buying rentals. We're talking about is buying a house for yourself versus say renting a good investment. So before I get any further, again, welcome Rob. I hope you're doing good today.
Yeah.
Um, so a lot of people ask all the time, especially with prices going up in your business as a realtor.
Yeah.
Do you get clients saying to you, hey, is this sort of a good investment? Does it make sense still, even though prices are up, quite a bit in the last year or so? What are you hearing?
Yeah. So, I mean, a lot, you know what, David, I don't even think a lot of them really look at it like an investment. They just look at it like, it's a home. It's their shelter. It's a home to live in. But I don't know that they necessarily look at it like an investment. I mean, yeah, okay. If you're paying rent, they want to stop paying rent to their landlord and they'd rather put their money into something that they're starting to build equity into something, right? It's now an asset kind of thing to look at, but it's to having the conversation or having them speak about it as an investment. Not really. I mean, the one thing is like right now homes are selling for over asking, right? Whether the home is listed at market value, grossly below market value, uh, typically most people are paying over asking. So a lot of them don't want to pay over asking. A lot of them do say that, but now you're right. It's how do you look at it like an investment?
Yeah, exactly. I mean, a lot of people don't necessarily ask. I think you're right, but you always hear people, talking about your home as your biggest investment, right?
Yeah.
And in my business, your mortgage as your biggest sort of commitment, when it comes to signing up for a debt of hundreds of thousands of dollars. So I think it's worthwhile to have a good discussion about whether or not buying a home is actually a good investment. There are many people out here who would
Yeah.
argue that it's not. You should just avoid the expense. So I don't want to pay for maintenance. I don't want to pay property taxes. I don't want to have major problems go wrong. I don't want to replace a furnace or a roof or any of that stuff.
Yeah.
So I guess it's worth asking the question: is it really a good investment to buy a home? And I think of course some of it is dependent on the individual, but why don't we talk about sort of three things basically, right?
Yeah.
I think, and you touched on one, which was appreciation. So tell me
Yeah.
more about as an investment, what can someone expect when they buy a home as far as appreciation, year over year, just like they would if they were buying putting some money in their RSP or buying a stock or something like that.
Yeah, well, that's just it, right? And so going back to that point, a lot of the conversation is a lot of people want to try and time it, like stocks or something like that, and they're like, "Oh, I'll wait to see how the market shifts." But going back to appreciation or the increase in home equity, typically what you would see is the value of a home would go up on average, say 6 to 7% every year. Now, this has been different over the last couple of years due to COVID, in that, we've been seeing in upwards of 20, 25, even 30% of the value of the home going up. So now you look at it like if you're going to get in, you're paying for the appreciation or the equity in the home upfront, right? So you're paying a couple of years upfront to get that home. But I mean, if you think about it, you're getting the home that you're going to be spending, the next 5, 10, 20, however many years in, right? And it's about having a plan. So are you going to be living in it for 5 years, 10 years, 20 years? What does that look like? And is it worth investing, the 2 to 3 years or however much extra you're going to be spending upfront, right?
So it sounds like you're saying, normally somebody would expect that their investment would return, say, 6 to 7%. a year, in
Yeah.
the long run. But right now with prices, you're paying for a couple of extra years because, the pricing is up higher than it would normally be. And
Yeah.
I mean, we could all speculate all day about what's going to happen next year or the year after, but the reality is that, you know, none of us really could tell you with any certainty.
Yeah.
But history will show you that in general, real estate pricing doesn't take massive long-term dips, right? It's
No.
either going to be
No.
usually slow and steady. Last couple of years
Yeah.
have been different in this market. So yeah, I guess I'm with you. Is that I would say that even though it may feel expensive today, if you have a
Yeah.
long-term outlook, then paying a little bit more for that property than you would have paid last year is really, no, you're not worse off to do that than you would be if you had
Yeah.
sat on the sidelines and not bought at all. So number one for me, appreciation for sure. When
Yeah.
you look at 5 to 6 or whatever percent on average, forget buying it this year and making 12% or 20% or something crazy like that. 5 to 6% is it's a reasonable return in the long run. Okay. Now some people
It
say you
is.
could do better
Yeah.
in the market, but I think there are other things we need to add on to this that will make this even more interesting. So number
Well,
one, appreciation.
yeah. And here's another thing. I talked to clients that bought last year, right? And at the time, a year ago, they told me, "Oh, I wish I would have bought a year ago."
Mm,
But the people, my clients that bought last year, imagine what they're thinking now when that home that they just bought just appreciated 20%.
hmm
Yeah, I mean, at that time, they wish they had bought a year ago. And then my clients that bought 2 years ago, they wish they would have bought a year ago. It's funny. People always say, I
Yeah.
wish I would have bought a year ago. So the ones that are sitting on the sidelines right now, waiting for the market to go down, what are they thinking? What are they
Yeah.
saying? Or what are they going to say?
Well, you know what
So
they say, right? The best time to plant a tree was yesterday because it
that's
takes time. And no
exactly
matter
right.
what, no matter when you do it, it's never going to be,
Yeah.
you're never going to pick the perfect time. And the best time to buy a
Yeah.
house was yesterday. If you
Yeah.
have a long-term outlook, right? So of course there
That's
will be, little ups and little downs over time, but in general, if you see real estate as an asset that goes up in the long term, which
yeah.
most people do,
Yep.
then sitting on the sidelines will not help you, even if you feel like you could perfectly time it, which you can't. And the same
No.
goes in investing. You can't time the market consistently over and over. You're better off to be in, than be out. So for number one, for
Yeah.
sure, appreciation. So let me
Yes.
throw something else at you.
Okay.
This is more on the tax side, but I think some people would argue, well, hey, David and Rob, 5-6% doesn't excite me, right? Like I'm
Yeah.
making 8 or 10% in my investment, or I'm making some other return, in some other investment. And if I could use that money, if I had $100,000 to put down in a house, or two hundred
Yeah.
thousand dollars, or $50,000, whatever it is, I'd be better off to put that money in my Wealthsimple account, or
Yep.
buy something else.
Yep.
Well, your primary, remember we're talking about your primary residence. So let's talk about the fact that it's capital gains exempt. So let's talk about the fact
Mhm.
that the growth on your primary residence, when you do take that money out, that 5-6%, and you do sell it, that's
Yeah.
tax-free money,
Yes.
right? So
Yeah.
even though, housing may seem expensive, I bet people don't necessarily think about the fact that every other investment you're going to pay either income tax on the money that it pays you, if it's like a dividend, or if it's interest income, or you're going to pay capital gains, which gets paid on half of the amount that you grew by. So
Yeah.
that, imagine you paid $100,000 for an investment, or you put $100,000 down. That $100,000 you pay for an investment that grows to 2, 3, or 400,000 over many years. Well, the difference, that growth there, half of it gets subject to tax at whatever
Yeah.
rate that you are. So,
Yeah.
you effectively, in my opinion, doubled your return on your primary residence versus another investment because you didn't pay capital gains,
Yeah. Yeah.
right? So that's the second thing. And again, I don't know if people are really thinking about this, but when you combine that like slow and steady appreciation with the fact that it's tax free, basically,
Yeah. Yeah.
it becomes really hard for me to beat investment in your own home.
Yeah.
right?
Yeah.
So that's the second thing that I think is super important again. And I think clients who, they worry about having a big mortgage, or they worry about just the cost of housing in general, and they'd say I'd rather rent. I
Yeah.
can certainly understand. And you know if somebody has a short-term outlook, like, hey, I'm only going to live there for a couple of years, and then I'm planning to move, or my job is really I get that my job's flexible, I might be relocated or whatever. I understand. But
Yeah.
if you have a medium to long-term outlook, and you plan on staying in the same community for a while, certainly at least for one mortgage cycle, 5 years or more, it's hard. I
Yeah.
think it's hard to beat that, right?
Yeah.
So then to me there's one more thing. There's three things. And the last thing to me is leverage. So what I mean by that is that it's really hard to find another investment where the average person can borrow that amount of money. So you can borrow 95% of the price of the house, right?
Yeah.
It's
Yeah.
better to have more down. It's better to have more, for sure. You could borrow, 90%, or you could borrow 80% and avoid the insurance. So that's still what that really means. And I think people need to understand this, is that if you had a 20% down payment, or a 10%, let's say 10% down payment, because that's pretty common. You have a 10% down payment. Every dollar of appreciation, like we talked about appreciation before, right? So
Yeah.
every dollar of appreciation in your house gets amplified because you only spent 10% of the money out of your own pocket to get that dollar.
Yeah.
Right. So in an RSP, right, people will say, well, it's not as good as an RSP because I get tax-free growth in my RSP too. Well, that's true. But what you don't get is that amount of leverage. So you get tax-free growth on the property, you get appreciation over time, and you put $100,000 down to buy an asset worth $1 million.
Yeah.
Right. Well, it's a little bit more in a house that price, actually, to be fair. But
Yeah.
in general, a lot of cases you could put, say 20% would be the most you would need in most cases. So that 5 to 10 times amplifier of your growth, right? So let's do some basic math, because I don't want to go too deep into the math. I'm not prepared for that. But you buy a house for $500,000 and you put $50,000 down. That house goes up by, you said, Rob, 6% on a normal year.
Yeah.
Let's make it 5, okay? Just to be conservative. So on the $500,000 house, it appreciated in 1 year by $25,000.
Yeah.
Right? So that's $25,000 of growth. You don't see it, you don't receive it in your hand, but it's there in the house, and you'll get it back.
Yeah. Yeah.
So then, remember, you only put down $50,000. So on your upfront spend of $50,000, in 1 year, it grew by $25,000. So that's not a 5% return. That's like a 50% return. And it's tax-free when you take it out. So to me, like, when you wrap all that together, you can argue that in the short term, housing is expensive. And you can argue that, a roof is expensive that you do once every 20 years. And, new windows and a furnace, those are all expenses. That's true. But when you can take a $50,000 investment and you can grow it by $25,000 a year, with leverage, with appreciation, and with, tax-free growth, I just don't see how you can really do a lot better than that with most investments here in Ontario.
Yeah.
So I don't know if you get clients who come out and ask about investment properties for themselves, or if they just think about their, second or third property as their investment. But are we talking enough about the investment value of your own home? What do you think? Because in the beginning you said not a lot of people are asking about that.
No, not a lot of people are. It's probably the more kind of savvy people that are looking to invest into other homes, right? And now into investment properties, that they see the value in that.
Yeah.
So.
Yeah. And investment in second and third property, additional, there are other costs. The mortgage rate's a little higher, and you have to pay capital gains on the second house. So everyone knows. Yeah. But even then, with the power of leverage, if you put 20% down on that second house, you're still getting a 5x multiplier on your growth, right?
Yeah.
And
Yeah.
so that's way better than putting that money into the market. And even if you got a little bit better return than 5, maybe you got 8 or 9, but in the long run, you're probably not going to get much more than that.
Yeah.
So, especially in a market that's reliable and stable, right? Real estate market is usually pretty reliable. So
Yeah.
I just think that it's really worth having a video like this where people realize, wait a second, let's open our eyes and look at the value of our own primary residence as an investment, even when things seem a little bit more expensive than I want to pay. Like you said, I just feel like we're always better to be in the market than out of the market.
Yeah. 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 It's, I mean, it just makes sense. And, we're not here for financing 101, but,
No.
I mean, we're just, yeah, here to, give some information in that.
Well, I just think because the reason what I mentioned is that a lot of people are going to be thinking, hey, I have a significant savings in my RSP, or I
Yeah.
have money that I have to put down to buy this house, right? So
Yeah.
should I do it? Right. Of course, if you
Yeah.
don't have the down payment, then you have to save and it takes time. But
Yeah.
yeah, I just think that, Canadians need to continue to look at real estate as a valuable investment. And
Yeah.
I think a lot of clients do. And those that don't see it yet, hopefully they get some value out of a video like this. So,
Yeah.
yeah. Any final thoughts, Rob?
No, just yeah. I mean, if you take a step back and you just think about it, right? It just does make sense that buying a home is a good investment. So
Yeah, exactly. Exactly. I mean, always, and be in the market versus being out of the market, right? So,
yeah.
anyways, with that, our short tip always turns into a longer video than we want, but why don't we call it
Yeah.
here? Well, thanks everybody. Thanks, Rob, and we'll end it off again. If you have questions and you want to reach out to either of us, I'm David Pipe, a local mortgage agent, and I'm a host here with Rob Kent, local realtor. We're happy to answer
Yeah.
questions or provide information at any time if you want to learn more about real estate or getting a mortgage. Thanks very much, everybody. Bye.
Bye.